Friends, in this video, I'm going to talk to you on the topic, why you need to correct your mutual fund portfolios. Everybody went into the mutual fund space on their own or with advice during the last 3-4 years, and the number of people who have come into the market in mutual funds has jumped exponentially. What we need to understand is that people bought mutual funds between 2020 and now purely based on past performance, and certain funds did manage to show very high past performance. If you look at some of these funds, in 2020 their 5-year performance was exceptional, but today they don't look all that great. In fact, their 1 year, 2 year, 3 year is all struggling, and some of these high performing funds of 2020 are struggling very badly today to even meet benchmark performance. In fact, they are lagging the benchmark very significantly. What has really gone wrong? Firstly, I think that past performance should never be used as the single decision factor. You can't buy a mutual fund simply based on past performance, because there are times when the past performance looks its best. A fund would have packed its portfolio with expensive companies, and those companies may be trading near peak valuation. If you held the same stocks in your portfolio, what should you do? You should sell and go to safety. But in a mutual fund, you are told to stay, remain invested, or think long term. All three phrases are abused in this context by everyone concerned. Why do they do this? They do this because they want to retain assets, but they don't take the effort to retain the asset in the right place. If I may say, what is the single largest mistake which the mutual fund industry always does? What is the biggest weakness of the AMC business? In its quest for assets, in its desire to keep AUM strong and growing, it dissuades investors from moving money from riskier parts of the market to safer parts of the market, because if the money goes from a fund to the account of the client, they are not sure it will come back. It's as simple as that. So, you may ask, I am in the direct option, there is nobody to influence me. Why do you say this? You don't realize how much of influence is working on you. If you think that platforms and those who want the direct option to be strong are actually doing it for your sake to save you that small fees, you are sadly mistaken. They are doing it because they also want that stickiness, because stickiness is the primary reward for all stakeholders except the investor. For an investor, stickiness is discretionary. In 2020, 21 or 22, around that phase when shares of expensive, costly quality stocks were hitting the roof, you should have redeemed from those funds. Instead, people are putting money at the maximum pace. What made people do that? Ask that question. I think it's the platforms, it's the influencers, and it's the AMC industry. All three together played ball. In the process, retail investors who have come into the market into these funds have had a rough experience and are still living in hope. But is there really hope? I think not, because there was a context to this style of investing, and that context ended at the peak of the COVID bull run. I don't see that context return anytime soon. So, investor has to move to a different context. As I said, the investor has to move from a riskier part of the market to a safer part of the market, from where he'll again grow. That's the way investment should work. But by dissuading you from moving or keeping you in the wrong place, all stakeholders don't do you any good. Advisors are supposed to do that, and that's why we are here in this business. I wish more people did that more actively. Sending the money back to a client's account should not be a problem. If you're doing a good job, the client will give you back the money. So, if at all you're fearing sending that money back to the client's account, the reasons are quite obvious. You're not sure that he's going to come back. As far as I'm concerned, it really doesn't matter, because at every point in time, you must give the investor the best choice. You must weed out the bad choices in his portfolio. You must guide him to make investments when the opportunities are in his favor. And you must always keep his portfolio safe, solid and sturdy. paying a small sum for that is not going to be anybody's complaint. The problem with people is that they paid money and got this experience of stickiness above everything else, and that's angering a lot of people. But I don't think that people should also look at everybody and paint everyone with the same brush, because many of us have worked very hard to do exactly the opposite of what is wrong, which is what is right. So you can't say that everybody is the same. So you have to also have your common sense working to understand how somebody is doing something differently while everybody is doing the same thing. That responsibility is yours. You don't expect a magazine or a FinTwit or a Finfluencer or the AMC industry or a platform to come and tell you that, because they want stickiness. They are all working in their own way and getting rewarded and remunerated for ensuring this stickiness. Whereas stickiness has to at some point in time stop, and it is at that point in time that people try to keep the stickiness going with the maximum force. So you fall for that force. Whereas you need to break free from that force and take your money to a safer place. And breaking free from such forces is never easy, which is why advisors have a very important role to play for a long, long time to come. Thank you for watching this video.